Okay, I'm going to show you an example of the project that we just completed called Ironhorse. We started this Q1 of last year, 2023. Purchased the land, we began construction called Ironhorse Industrial Park. This project was also 2 buildings, about 330,000 square feet. So we started the first building, we completed in less than 12 months. Building 2 was started about 4 months later. Completed that in 12 months. Construction partners, like I said, Crossland came in under budget on both buildings. And we have now just signed a triple net lease from a credit tenant, a publicly traded company on building 1 and building 2. We just delivered a few months ago and have several LOIs for interested parties. So a lot of momentum on the leasing front. We just signed leases above pro forma rate, and timelines for our budgets have exceeded beat our pro forma. And so the intention was similar to this project where we're looking at multiple options. Do we sell or do we do a refinance and hold it for a little bit longer? Well, right now is not a great time to sell, right? As most people understand. And so we evaluated the potential of that, but then we started evaluating what permanent debt products look like. So despite the much higher interest rates that are 5% higher than they were when we started this project, and the lower leverage ratios that lenders are putting out on stabilized projects, we're actually still expected to return capital, partial capital back to investors and continue to cash flow until we dispose of the asset, probably a couple of years down the road as the market improves. So again, that flexibility I was talking about, we have that ultimate option set to figure out what's the best approach based on where the market's at. Well, with the new debt we're getting out of the building 1, it's only gonna be a 65% LTV. That's kind of the market right now. But even at that lower LTV, we're expecting to send back about 25 to 30% of capital allocated to that first building back to investors, and we can cash flow on a triple net lease with the credit tenant. And you can look at some of the numbers here. We are all in cost for construction. We're about $16 million. Current estimated value is about $21 million right now. We expect that to increase over the next couple of years as inflation and some of the rent escalations in this lease get increased and as the market continues to improve. So based on that current estimated value, this is not a guaranteed return, but the unrealized equity gain that our investors have received on this building is about 61% in about an 18-month time period. So you can see, why this is such a compelling story here is, we hit our timelines, beat our pro forma on lease rates. We're actually able to return capital back in this market, right? That's pretty rare. Most of the refinances I hear about right now are cash in refinances. We actually have to send money to the lender to pay them off versus actually get money from a lender as additional cash out.